Imagine this. Margaret is 71 years old. She worked for 38 years as a school librarian. She retired. She did everything right. But last April, she sat at her kitchen table with her tax return in front of her. She owed the IRS over $2,000. $2,000 she did not have. She called her daughter in tears. What Margaret did not know is that the IRS had given her 5 separate tax breaks, 5 legal ways to lower that bill, some of them down to 0, but nobody told her. Not her tax preparer, not her bank, not even the IRS themselves sent her a letter. And Margaret is not alone. Millions of retirees over 65 are overpaying the IRS right now, this year, today, because they have never claimed a single one of these 5 tax breaks. That changes right now. I am Edward, and on this channel, I help retirees and seniors understand the rules that protect your money, your benefits, and your peace of mind. Today, I am going to walk you through 5 tax breaks the IRS specifically created for people over 65. I am not going to use complicated tax language. I am going to explain each one as if we were sitting together at your kitchen table. I will tell you what the tax break is. I will tell you who qualifies. I will tell you exactly how to claim it. And I will tell you the mistake that causes most people to miss it. Now please stay with me all the way to the end of this video, because tax break number 5 is the one almost nobody knows about. And it is the one that could save you the most money while also protecting your Social Security from being taxed at 85%. I will explain exactly what that means, but first let me tell you what happened to Robert. Robert is 67 years old. He retired 2 years ago from a manufacturing company in Ohio. He collects Social Security, he has a small pension, and he has an IRA that he built up over the years. Every year, Robert does his taxes himself using the basic form 1040. He does not itemize. He just takes the standard deduction and sends it in. Sounds reasonable, right? Here is the problem. Robert never checked the box on his return that says age 65 or older. That one unchecked box cost him $2,000 in extra deductions he never received. But it gets worse. In 2025, the government passed a brand new law that gives seniors an additional $6,000 deduction on top of everything else. Robert had no idea it existed. His tax software did not flag it. His neighbor who helps him with paperwork did not know about it either. So Robert filed his return without it. Then, in December, Robert's IRA required him to take a minimum distribution. $30,000 came out of his account and went straight into his bank. He donated $5,000 of it to his church. But he donated it the wrong way. He took the money out first, deposited it, then wrote a personal check to the church. Because he did it that way instead of sending it directly from his IRA, every single dollar of that $30,000 was counted as taxable income. That pushed his combined income over the threshold. Suddenly, 85% of his Social Security became taxable. His Medicare premiums went up the following year, and he lost eligibility for the new senior deduction because his income was now too high. One unchecked box, one missed deduction, one wrong way of donating. It cost Robert over $4,000. Robert is not careless. Robert is not irresponsible. Robert simply did not know, and I do not want that to happen to you. So let us go through all 5 tax breaks right now. Tax break number 1, the higher standard deduction for age 65 and older. Let us start with the most basic one. The one Robert missed with a single unchecked box. If you are 65 or older, the IRS gives you a larger standard deduction than younger taxpayers. For tax year 2025, here is what that looks like. If you are single and under 65, your standard deduction is $15,750. But if you are single and 65 or older, it jumps to $17,750. That is an extra $2,000 shielded from taxes just because of your age. If you are married filing jointly and one spouse is 65 or older, Your standard deduction is $33,100. If both of you are 65 or older, it goes all the way up to $34,700. And if you file as head of household and you are 65 or older, your standard deduction is $25,625. Now here is something most people do not know. The IRS has a special tax form designed just for seniors. It is called Form 1040-SR. It has larger print, it is easier to read, and it is built to help you capture these senior-specific benefits. The trap here is simple. If you do not check the box that says you are 65 or older, or if your tax preparer misses it, you lose this extra deduction automatically. The IRS will not fix it for you. And there is one more detail. The IRS considers you 65 on the day before your 65th birthday. So if your birthday is January 1st, 2026, the IRS actually considers you 65 at the end of 2025. That means you qualify a full year earlier than you might think. If you missed this deduction in previous years, you can file an amended return using Form 1040-X. You generally have 3 years from the original filing date to go back and correct it. All of this is laid out in IRS Publication 554. That is the official tax guide for seniors. It is free on the IRS website. And if you need help filing, the IRS offers free tax preparation through the VITA and TCE programs for anyone 60 and older. AARP Foundation Tax Aid also offers free help at thousands of locations. Their number is 888-227-7669. Tax break number 2, the brand new Enhanced Deduction for seniors. Now this is the big one. This is brand new, and this is the one that most people, including many tax professionals, do not know about yet. In 2025, a new law was passed. It is called the One Big Beautiful Bill, and buried inside that law is a brand new deduction just for seniors. Here's what it says. If you are 65 or older, you can claim an additional $6,000 deduction on top of everything else. If you are married, filing jointly, and both of you are 65 or older, you can claim up to $12,000. This is not a replacement for the higher standard deduction we just talked about. This is added on top of it. So let me show you what this looks like when you stack everything together. If you are a single filer, 65 or older, with income below the phase-out threshold, here is your total protection. Your base standard deduction is $15,750. Your age addition is $2,000, and your new enhanced deduction is $6,000. That is a total of $23,750 shielded from federal income tax. If you are married filing jointly and both of you are 65 or older, the total is even bigger. $31,500 plus $3,200 for the age additions, plus $12,000 for the enhanced deduction. That adds up to $46,700. Let me say that again. $46,700 protected from federal income tax. Now, who qualifies? You must be 65 or older by the end of the tax year. You must have a valid Social Security number, and your modified adjusted gross income must be below $75,000 if you are single, or $150,000 if you are married filing jointly. But here is what most people get wrong. If your income is above those numbers, you do not automatically lose the entire deduction. It phases out gradually. It goes down by 6 cents for every dollar you earn above the threshold. It does not fully disappear until your income reaches $175,000 for singles or $350,000 for couples. So even if your income is $80,000 or $90,000 or $100,000, you may still get a partial deduction. Do not assume you are disqualified without checking. This deduction is available for tax years 2025 through 2028. That is 4 years of savings, and it can be claimed whether you take the standard deduction or itemize your deductions. But here's the most important thing I can tell you about this tax break. It will not be applied automatically. You must claim it yourself on your tax return. The IRS will not add it for you. If you do not claim it, you lose it. The IRS published a dedicated page on their website in February 2026 titled, "Check Your Eligibility for the New Enhanced Deduction for Seniors." You can find it on irs.gov. And IRS Publication 554 has a full section with calculation worksheets to help you figure out your exact amount. If you miss this deduction for 2025 at a 22% tax rate, that is up to $1,320 lost for a single filer, or up to $2,640 for a married couple. And that is just 1 year. Multiply that by 4 years, and you are looking at potentially over $10,000 left on the table. Tax break number 3, the credit for the elderly or the disabled. Now, I want you to pay close attention here, because this tax break is different from the first two. The first two are deductions. They reduce your taxable income. This one is a credit. A credit reduces your actual tax bill dollar for dollar. If you owe the IRS $4,000 in taxes and you qualify for a $3,750 credit, your bill drops to just $250. This credit is claimed on something called Schedule R of Form 1040. And according to AARP, it is one of the most overlooked credits in the entire federal tax code. The credit ranges from $3,750 to $7,500 depending on your income and filing status. To qualify, you must be 65 or older or under 65 and permanently and totally disabled with taxable disability income. But there are income limits, and you must pass both tests. If you are single, your adjusted gross income must be below $17,500, and your non-taxable Social Security, pension, and disability income must be below $5,000. If you are married filing jointly and both of you qualify, your AGI must be below $25,000 and your non-taxable income must be below $7,500. If you are married filing jointly but only one spouse qualifies, the limits are $20,000 for AGI and $5,000 for non-taxable income. And if you are married filing separately and lived apart from your spouse all year, the limits are $12,500 for AGI and $3,750 for non-taxable income. Now, I know those income limits sound low, and that is exactly why most people never even look into it. They assume they do not qualify and they move on. But here is what I want you to hear. If you are a low-income senior living primarily on Social Security, you may very well qualify. And if you do, this credit could eliminate your entire tax bill. And here is something beautiful. If you are not sure whether you qualify, you can check a box on Schedule R and ask the IRS to calculate the credit for you. They will do the math. You just have to file the form. The IRS also has a free online tool called the Interactive Tax Assistant on their website. You can search for, "Do I qualify for the credit for the elderly or disabled?" and it will walk you through the questions step by step. The full instructions are also in IRS Publication 524. If you qualify and you have not been claiming this credit, you can file Form 1040X for prior years within the statute of limitations and get that money back. Tax break number 4. The medical and dental expense deduction, including your Medicare premiums. If you are over 65, chances are your medical expenses are significant. Medicare premiums, prescription drugs, dental work, hearing aids, eyeglasses, nursing care, even the cost of installing grab bars or a wheelchair ramp in your home. The IRS allows you to deduct all of these if your total unreimbursed medical expenses exceed 7.5% of your adjusted gross income. Let me give you a real example. Say your adjusted gross income is $50,000. 7.5% of that is $3,750. If your total medical expenses for the year are $10,000, you can deduct the amount above that threshold. That is $6,250 in deductions. At a 22% tax rate, that saves you over $1,300. Now here is the mistake almost everyone makes. Most seniors do not realize that their Medicare premiums count as deductible medical expenses. Your Part B premium, your Part D premium, your Medigap or Medicare Advantage premium, your long-term care insurance premium. All of these can be included in your medical expense total. In 2025, the standard Part B premium alone was $185 a month. That is $2,220 a year just from Part B. Add in Part D, a Medigap policy, and your other expenses, and you can reach that 7.5% threshold faster than you think. And here is another mistake. Many seniors have their Part B premiums automatically deducted from their Social Security checks. Because they never write a check for it, they forget to include it in their medical expenses when they file their taxes. That money still counts. Do not forget it. Now, if you are self-employed, even in a small way, and you have income on Schedule C, you can actually deduct your Medicare premiums above the line on Schedule 1 without even needing to itemize. That means you do not have to clear the 7.5% floor at all. And one more thing, if you paid medical expenses in a previous year and forgot to claim them, the IRS says in Publication 502 that you can file Form 1040X to go back and claim them. You generally have 3 years from the original filing date to do this. Seniors in nursing homes or with long-term care needs can have deductible expenses running into tens of thousands of dollars. If you are not claiming these expenses, you are leaving real money on the table, and the IRS has no mechanism to alert you. Tax break number 5, qualified charitable distributions from your IRA. Now we have reached number 5. This is the one I told you to stay for, and this is the one that could have saved Robert thousands of dollars. If you are 70.5 years old or older, the IRS allows you to donate money directly from your traditional IRA to a qualified charity. This is called a qualified charitable distribution, or QCD. In 2025, you can donate up to $108,000 this way. In 2026, the limit goes up to $111,000. If you are married, each spouse can make their own QCD from their own IRA, so the combined limit is $216,000 in 2025 and $222,000 in 2026. Now, most people are not donating $100,000, but even a QCD of $2,000, $5,000, or $10,000 can make a real difference. Here is why this matters so much. When you take a required minimum distribution from your IRA, that money counts as taxable income. It goes on your tax return. It raises your adjusted gross income, and that higher income can trigger a chain reaction. It can push up to 85% of your Social Security benefits into taxable territory. The thresholds for this have not changed since 1983 and 1993. For single filers, once your combined income goes above $34,000, up to 85% of your Social Security can be taxed. For married couples filing jointly, that threshold is just $44,000. Higher income can also increase your Medicare premiums through something called IRMA, the Income-Related Monthly Adjustment Amount, and it can phase you out of the new $6,000 enhanced deduction we talked about earlier. But when you do a QCD, the money goes directly from your IRA custodian to the charity. It never touches your bank account. It satisfies your required minimum distribution. And it is completely excluded from your taxable income. You do not need to itemize. You do not need to claim a charitable deduction. The money simply never appears as income on your return. Now here is the critical rule. The money must go directly from your IRA to the charity. You cannot take the money out first. Put it in your bank account and then write a check. If you do that, it does not count as a QCD. The IRS will treat the entire amount as regular income. That is exactly what happened to Robert. When you report a QCD on your tax return, you put the full distribution amount on the IRA distribution line of your Form 1040. But on the taxable amount line, you enter 0, and you write the letters QCD next to it. Starting with 2025 distributions, the IRS has also added a new reporting code, the letter Y, on Form 1099-R specifically for QCDs. So tracking this is getting easier. One last important detail. The age for QCDs is 70 and a half, not 73, which is the current age for required minimum distributions. That means you can start making QCDs before you are even required to take RMDs. That gives you extra years of tax-free charitable giving. And remember, this cannot be done from SEP or simple IRAs. It must come from a traditional IRA. You must have a written acknowledgement from the charity, and you cannot have the check made payable to yourself. It must go directly from your IRA custodian to the charity. Seniors who failed to do QCDs in prior years cannot go back retroactively. The distribution must be structured as a QCD at the time it occurs. You cannot convert a past withdrawal into a QCD after the fact. That is why it is so important to set this up now before your next distribution. All right. We have covered all 5 tax breaks. Now let me give you 3 steps you should take this week. Not next month, not next year, this week. Step 1. Get a copy of IRS Publication 554. Go to irs.gov and search for Publication 554. It is called The Tax Guide for Seniors. It is free. You can read it online or print it out. This one document lists every tax benefit available to you as a senior. It covers the higher standard deduction, the new enhanced deduction, the credit for the elderly, medical expense rules, and more. Keep it next to your tax documents. Treat it like your tax protection manual. Step 2. Review your last 3 tax returns. Look at whether you checked the age 65 box. Look at whether you claimed the new enhanced deduction for 2025. Look at whether you reported medical expenses. Look at whether you used a QCD or took your RMD as regular income. If you find a mistake, you can file Form 1040X, the amended return, and you generally have up to 3 years to correct it. You could be owed a refund right now and not even know it. If this feels overwhelming, do not worry. You do not have to do this alone. Call the AARP Foundation Tax Aid Program at 888-227-7669. They offer free tax preparation help at thousands of locations across the country. You can also call the IRS VITA and TCE program at 800-906-9887 to find a free tax assistance site near you. These services are specifically designed for seniors. They are free, and the people there understand exactly what we talked about today. Step 3. Talk to your IRA custodian about setting up qualified charitable distributions. If you are 70 and a half or older and you donate to any charity, church, or nonprofit, call your IRA provider this week. Tell them you want to set up a QCD. They will send the money directly from your account to the charity. It takes a few minutes to arrange, and it could save you thousands of dollars in taxes, Medicare surcharges, and Social Security taxation every single year. Do not wait until December. Do not wait until tax season. The best time to set this up is right now while you are thinking about it. Now, I need to ask you something important. How many of these 5 tax breaks did you already know about? Be honest. If the answer is less than 5, you are not alone. Millions of seniors are in the same position. And here is what concerns me. The rules change, new laws get passed, deadlines come and go, and the IRS does not send you a letter saying, "Hey, you missed a $6,000 deduction." YouTube is a wonderful place to learn. But the algorithm does not always show you my videos when they come out. You might miss the one video that could save you thousands. That is why I created something specifically for you. I have set up the Global Senior Alerts official WhatsApp channel. When you join this channel, you will receive real-time alerts whenever there is a change to Social Security, Medicare, pensions, banking rules, insurance policies, or tax laws that affect seniors. You will also be able to download a free Senior Benefits Protection Guide. This guide puts all the key rules, deadlines, phone numbers, and forms in one simple document that you can print and keep at home. The link is in the description below this video. Click it right now and join before you forget. And while you are here, please do me a small favor. If this video helped you, hit that subscribe button and tap the bell so you do not miss the next one. Share this video with a friend, a neighbor, a family member, anyone over 65 who files taxes. You could save someone you love hundreds or even thousands of dollars. Leave a comment below and tell me which of these 5 tax breaks you did not know about. I read every single comment, and your questions help me decide what to cover next. I am Edward. I am here for you, and I will see you in the next video.